Hey, this is Justin with Figuring Out Finances. Sorry I'm a couple days late. My goal at the onset of this was to try to put out a video every Friday, and we had a little bit of a busy week, so here we are on Monday getting this thing done. So today I wanted to give a little update on how our investing's going, but more importantly, we're going to talk about expense ratios when it comes to investing and how that can make a long-term impact on your total return while you're investing and saving for the future. So what is an expense ratio? Well, it's the total cost to run the fund divided by the total assets of the fund. So it's basically like operating costs for whatever fund that you choose to invest in. So if you're picking individual stocks, you're not going to have an expense ratio because there's no active management going on. They're just individual stocks. But if you have a fund, even like an index fund, you're going to have at least some kind of low expense ratio, which is what it costs to keep the fund going, to make trades, different things like that. Expense ratios are generally higher for actively managed mutual funds, and they're lower, generally speaking, for index funds, which is kind of why I prefer index funds myself. And while expense ratios may seem unimportant or small, just like compound interest, over time, they actually end up making a pretty big difference in what you end up with in the long run. For an active manager to beat an index fund, so like an actively managed fund would be, you'd have somebody managing the fund and making trades, trying to beat the market. That would be an actively managed fund. So for an active manager to beat the index, basically their performance needs to match what the index fund does or just what the market does over a course of time. Plus, they also need to make up for whatever added expense or management fees that they have involved. So this makes it challenging for active managers because they not only need to meet the market, but they need to beat the market by a certain margin. And we'll kind of take a look at what those numbers might look like. So sharing a few expense ratios on funds that we've talked about and funds that I like. I've said it before in other videos, but I'll say it again. None of this isn't advice. This is just kind of observations that I've made. You're free to do the investing that you choose, and not only would I take my advice with a grain of salt, I probably wouldn't even strongly consider it as good advice, since I am not a professional when it comes to this stuff. So starting out with the VGSTX, which is that Vanguard Star Fund that we've got our $1,000 plus the $5 a day invested in, that has a 0.31% expense ratio, which is relatively low. My wife and I are invested in VSGAX for our Roth IRAs. We like that because it's a target date retirement fund for 2060. And we'll talk about target date retirement funds in another video. But I like that one because it's got a really low expense ratio at 0.08%, so significantly less even than the Star one. And then below that, even if you had the VTSAX, which is Vanguard's total stock market fund, that one's even lower at 0.04%. So it's a very inexpensive fund to own and to have grow for you over the long term. Interestingly, from Investopedia, during the year of 2022, this past year we just wrapped up, the average expense ratio for a managed fund or an actively managed fund is 0.68%. So significantly higher just for the expense ratio portion. This doesn't even take into account management fees, which are usually on top of an expense ratio for a fund. So not only are you going to pay that average of 0.68%, but typically active managers will take 0.5 to 1%, maybe in some cases, to actively manage your retirement for you, all while, of course, trying to beat the market. So next, we're going to hop on the computer and take a look at what some of these numbers calculate out to over the long term, because it really is good to have a visualization of, how much are these differences in expense ratios going to cost, depending on what you're holding, and depending on if you want to do an index fund approach where it's pretty passive versus having somebody actively manage your retirement saving for you. So let's have a look. We're going to have a quick look at what our $1,000 here could do over the course of time. This is just a calculator on nerdwallet.com, so it's kind of useful for calculating out, in this case, the expense ratio and what that's going to cost us for an investment like this. So our initial investment here is $1,000. Planned contributions per year, so I just took the $35 a week or $5 a day and then did 35 times 52 weeks in a year, so that's how you get the 1,820. That'll be the yearly contribution for this example. And then just for the sake of this example, we're going to do a 30-year projection to see what this amount of money could be worth if we continue to invest this amount and start with the $1,000. And for the rate of return, 7% is pretty average. In fact, it might be a little bit conservative, but you could set this to whatever you want if you're calculating your own future returns. And then we're going to start out with the VGSTX expense ratio. So that's 0.31%, as we talked about. So you can see down here that at the end of the 30 years, if we continue to invest at this rate, we'd have $180,000, give or take. And that expense ratio is going to cost us about $11,000 over the course of the life of the investment, which is a significant amount of money. So we're going to take a look at a couple other ones too. I mentioned the VSGAX, which is the 2060 target date retirement that Vanguard offers. That's got a 0.08 expense ratio. If we do the calculation on that, you can see this cost significantly drops. So instead of having $180,000 left over after expenses, this jumps all the way up to $188,000. So, and this is let's keep in mind too that this is a relatively small amount of money. A lot of people are going to need more than this to retire with. So these numbers really compound if you're investing more. So this is just an example, like I said, but it is worth noting that. Next, we'll look at the VTSAX, the VTSAX, which is the total index fund from Vanguard. That's got a 0.04, which is just extremely cheap. Then we calculate that out and we see here that we've got a very low cost of fees, the lowest out of all these that we're looking at today. So this is definitely worth considering. And then if we go with the 2022 average mutual fund expense ratio of 0.68% per year, you're going to see this is significant. So if we calculate this out, you're going to pay over $23,000 over the life of this investment. If you have somebody actively manage it for you. Once again, I'm not poo-pooing anybody that is having somebody actively manage their fund. For a lot of people, that is the right decision, and I will probably get to a point someday when it makes sense for somebody else to manage our money. But for right now, I just think these are interesting things to observe. So then two other ones I wanted to do is if we do the 0.68% average mutual fund expense ratio plus the 0.5%, we'll do 0.5 and 1% as two examples for the management fee that we talked about earlier. This is what we end up getting. So if we add those together, we get 1.18%, and we calculate that out. Quite a bit of fees. You can see it's a large portion of the total that you would earn over the course of the investment. And then if we bump this up to say if you had 1% of management fees plus the 0.68% for the average mutual fund expense ratio, this comes out to a kind of a staggering, in my mind, $52,000 that would not be yours anymore. That would go to whoever's managing your investment plus the expense ratio for the fund. So, at the end of that, you'd have $139,000, even though your investment did generate over $191,000. So interesting to look at. For an extreme example, management fees and stuff can get kind of out of control sometimes. So if you had something as high as like 2.5%, this is just, that's a massive chunk of the investment. So it's worth keeping these things in mind when you're looking at expense ratios. And this is why expense ratios are important, and it's worth taking time to shop around and find something that works for your investment strategy. Okay, and here at the end, I wanted to have a quick look at how our fund has done so far, the $1,000 plus the $5 saved every day for a year. So we had a little dip in performance, and that's fine. It's going to go up and down. The point is to just buy and hold here. So we're going to have good weeks and we're going to have not so great weeks. So far, as you can see, we've contributed $1,140 so far. And the total growth on the account is $8.84 is all. So you have a total amount or total account value of $1,148.84. And the gain or loss, we're up less than 1% so far. So pretty slow start, but that's okay. We've got a long ways to go until the end of 2023. So we'll see what happens. Thanks for tuning in, and we'll look forward to seeing you in the next video.